Today, I'm going to spend some time showing you how to actually figure out how you can qualify for a mortgage, like how it actually works. But more importantly, if you wait till the end of the video, I'm going to get into the specific tips that you can take to qualify for more. But don't miss the juicy middle, because we're going to talk about what's gross debt service ratio, how you can use it for you, and specifically how you actually qualify for a mortgage at a Canadian mortgage institution. So let's get right on into it. But before we get started, if you haven't already done so, hit that like button and the subscribe button, because if you like this content, you're going to like a lot more about what's coming. Now, the goal of the video really, as we just stated, is to teach you how to know how you qualify for a mortgage, and more importantly, how you could potentially qualify for more. So to do that, we need to really understand how a mortgage is qualified in the first place in Canada. Now, as you may know, there are different types of mortgage options in the country, and there are different types of institutions. So we're going to go over the general guidelines. Every single bank and institution throughout the country will offer different types of guidelines. And so before you think that this is the gospel, you have to keep in mind that every bank may have different terms and considerations, but that's obviously why you would come to us to help you out with your loan. But let's get into the basics, because if you don't know this, then you're walking in really blind. To start off with, I think the most important consideration is understanding what these two big acronyms are, GDS and TDS. Now, if you haven't heard of GDS or TDS before, these are the two acronyms which define realistically what you qualify for. GDS stands for Gross Debt Service Ratio, and TDS stands for Total Debt Service Ratio. And these are the ratios that are used for lenders to determine the percentage of your income which can be used for mortgage qualification. Now, of course, we can define income differently for different lending institutions, and different lending institutions, as I mentioned, have guidelines on how much income they'll look at. As a general rule of thumb, lenders will look at your gross income as the whole, not the net, which is the pre-tax income, and they're going to look at the percentage of that income which goes towards the actual housing debt. Now, housing debt can be defined as property taxes, strata fees or HOA fees, heat, and this is based on the square footage of the actual unit itself, and of course the mortgage payment. Now, the mortgage payment is using the stress test, which we'll talk about in just a minute, but let's go back to actually going over GDS. So starting off with, what is GDS and how does it work? GDS itself is broken down into a few components. Your gross income. So let's assume you have a salary today of $100,000, $100,000 being the gross pre-tax income that you receive right now. Your gross debt servicing allowance for a conventional typical mortgage is 39% of your $100,000. Now, there are some exceptions, but we'll use the standard less than 20% down qualified rules. So 39% of your gross income can go towards housing. So how that's broken apart is we take the property tax of the potential unit that you're looking to buy, the strata fees, as we mentioned, we take the heat, which is based on the type of unit you're purchasing. Now, different lenders have different heat amounts. In this case scenario, in this example, we'll use heat of $100 and assume it's a townhome, and we'll use strata fees. We look at these specific amounts as a percentage, and then what we do is we reverse to find how much as a percentage of your income you could afford annually in the case of a mortgage. Now, to understand the specifics of this, we also have to go into the stress test. So let's step over to the side. The stress test was introduced in 2016 in its first form, and then again in 2018 in its second form. So in Canada, every mortgage that is provided by a federally regulated institution, the borrower must prove that you can qualify at a rate that's 2% above the interest rate that you're getting. So for today's conversation, we'll assume that you're getting an interest rate of 5%. You would need to show that you can qualify based on the payments at 7% in this calculation. So again, using some backwards math, we'll use a 7% stress test on a 5% rate. We'll use strata fees of $350, property taxes of $3,000, and heat of $100 in our overall calculation. Now, generally speaking, there are different types of guidelines in terms of how much calculation and how much income we can use, but we'll walk you through that scenario as we move forward. Now, before we go there, we need to talk briefly about GDS as a whole. There are different numbers that you'll see out there. Some will say 32%, some will say 35%, and some will say 39%. The generally accepted maximum is 39% if you have a good credit score. Good credit score by most lending institutions is defined as a credit score on Equifax of above 680 or above 700 with some institutions. That doesn't mean you can't qualify with a credit score below that. However, that is a generally accepted guideline for most lending institutions. If your credit score is below that, and we suggest you work with a mortgage broker who can understand your story and relay that to the lender, because you might be able to still qualify. The second part of this equation is something called TDS. So TDS can be complicated for a lot of folks. So it's essentially the same as your gross debt service ratio. We're adding in the property debts, but now we're also adding in your other debt. Other debt can be defined as anything that would be showing on your credit bureau. Now this could include car loans, student loans. It can align a credit. It could be a credit card. It could be virtually any other unsecured debt or secured debt if you own another piece of real estate that is showing on your application. Now, generally speaking, the maximum total debt service ratio that you can qualify for is 44% of your gross income. So essentially 44% of your gross income can go towards all debts. This includes the mortgage that you're applying for and any other debts on your application. Now, as a bonus piece, we often hear about people saying, well, if I own this property outright, it should count as a positive towards my application. Not necessarily the case, because if you have property taxes or strata fees on another property that you own, those would be considered part of the total debt. Again, gross debt service ratio, total debt service ratio, 39 and 44 are the generally accepted guidelines. Of course, please keep in mind there are some exceptions to those rules. We'll cover that in a later video. So once you've figured out your gross debt service ratio and total debt service ratio, which is again the percentage, 39% of your gross income going towards your housing and 44% of your total income going towards all of your debts at this point right now, you can start to work backwards to figure out how much you would actually qualify for. But before we get into the specific scenario, I think it's important to understand why are GDS and TDS important and why does the government have these guidelines in place? Well, there's a lot of reasons that you would see GDS and TDS be very important, but it's a overall understanding of your financial health picture as defined by most federal regulations. Again, in Canada, they're regulated heavily by OSFI, which we'll get into again in a later video. But for today's conversation, generally speaking, almost every insured mortgage, which is a loan under 20% down, has to follow these guidelines. If you have more than 20% down, there are lenders who make some exceptions to these qualification ratios. If you have a strong profile, which is defined as perhaps additional income sources, perhaps a certain amount of money in your accounts, and or if you have a small loan relative to the value of the property itself. But for today's conversation, we're focusing on how you can figure out how you qualify. So let's get into it. We understand specifically, hypothetical, you have $100,000 of income. So today we're going to hop on and do a little screen record and show you now what you would qualify for using one of our great calculator apps. All right, so in this scenario, we're going to break down specifically what your maximum mortgage qualification would look like based on the assumption of $100,000 of annual income. So if you have $100,000 of annual income, and as we discussed, we've got $3,000 of property taxes, $350 for condo fees, $100 for heat, and we're using a 39% of your gross income, 44% of your total income. We're assuming that you have debt payments of at least $500, and we're qualifying your mortgage based on a 25-year amortization, which is the maximum if you have less than 20% down. We'll manipulate that in just a second and show you what it looks like if you have 20% down and you can do a 30-year amortization. But based on all of this qualification scenarios, you can see on the right-hand side, you have a maximum loan amount that you could borrow as of 2023 of $377,157 that you can borrow for this overall amount. So what we'll do is we'll show you a couple of manipulations to actually show you what would it look like if you had zero debt payments in your overall application as we move forward. So if we reduce your actual debt to $0, you'll notice that because your gross debt service ratio is maxed out, your total debt service ratio does not any longer provide you with a limitation, you can now borrow an additional $15,000 in this situation. Remember that total debt service ratio does provide a little bit of a buffer, so you could perhaps, for example, afford in this case scenario about $250 worth of monthly debt that you could borrow on your application without affecting how much you could borrow at any given time. And as we work our way through this, you'll notice that if we also adjust the amortization schedule to a 30-year amortization schedule, you'll see that your maximum mortgage amount will also increase to $413,754 if you did a 30-year amortization. Now, again, this is just one example of how you could qualify for your mortgage with less than 20 and more than 20% down. And there are so many different circumstances that could change or impact the actual amount that you would qualify for when it comes to a mortgage. But in an understanding of how GDS and TDS works, this will help you to understand what you can do. Now let's talk about some specific things that you can do in order to help you qualify for a higher loan amount when it comes to getting a mortgage application, because generally speaking, that is what people want to know these days. How do I borrow more? There's a few different things that you can do initially and a whole bunch of other things off the side. And of course, we'll talk about those bonus items as we move forward towards the end. Number one, and the easiest thing that you can do, pay attention to your credit score. As we indicated in the beginning, lenders are paying attention to credit scores. scores. And there's not one acceptable amount because different institutions have different qualifications. However, we can let you know that having a good credit score will eliminate any concerns over the amount of money that you can borrow. And if we ever require an exception from a lender, which is them providing a higher amount than what your typical income could allow, they will look at your credit score as one of the first considerations. Now, anything over 700 or in some cases 720 is widely accepted as a good credit score and would mean that you probably won't have any limitations as far as lending is concerned. But don't not apply because you don't have that credit score. There are some alternative programs. It just makes it a little bit easier, to be clear. Number two, your down payment. So if you put down less than 20%, you are limited by CMHC or Canada's guidelines on insurers as far as your qualification. You cannot go any higher than 39% of your gross debt service ratio and 44% of your total debt service ratio. Hard stop. There are no limitations. There are no exceptions to those numbers at all. But if you were to put down 20%, those numbers can change. In fact, some lenders will allow up to 44% of your gross debt service ratio, which is 5% above the allowance, and in some cases, even more if you have 20% down and a good, strong profile for your application. This doesn't mean you can't buy a home with less than 20% down. In fact, exactly the opposite. But if you're in a circumstance where you do have 20% down and you work with us, we can go to lending institutions, which will increase your overall qualification. Number three, rental income. Rental income can increase your qualification pretty dramatically in some situations. But as we talked about, every institution has a different way to look at this. For a $1,500 of rental income with a $100,000 of gross debt service ratio, one lender could increase your qualification by as little as $30,000 to $35,000 of mortgage money, whereas another could be as much as $120,000 of additional mortgage borrowing power. However, the rental income can help you in either case scenario. Again, another reason you want to be working with a professional who has access to different institutions. Now, our little bonus trick when it comes to your overall qualification is actually not that complicated. It's a combination of all of the above, but more importantly, working with someone who can look at different guidelines. Truthfully, different lenders all have different advantages and disadvantages and can look at the different ways that you qualify. But if you're working with a professional who can look at the different institutions and look at the different guidelines and you have a clear goal, they should be able to help you determine how to qualify for a higher loan amount or what you can do to plan to qualify for a higher amount if that is your objective goal in the future. So if this helped you out, here's one last step that you can take. If you go into the comments below, you can actually download our mortgage app and start playing around with your qualifications. Now, to be clear, the app itself is very conservative and it doesn't use all of these different examples. But if you're looking to just do a general guideline and get a rough idea of what you could qualify for conservatively, download the app and do the pre-qualification right there on your phone itself. Remember that those numbers are conservative and you might actually qualify for more. So if you want to take the next step and actually see what you can actually qualify for, make sure to send us a message so we can look at all of your options. If you found this video helpful, hit that link, hit the subscribe, go download the app, and we'll see you on the next one.